Good morning, everyone. This is John Cogan, the CEO of Proformative, the online community for corporate finance, accounting, treasury, and related professionals. I would like to welcome everyone to this morning's webinar, Going Global, Expanding Internationally the Right Way. Many companies reach an inflection point where growth requires international expansion, whether selling into and delivering or producing products and services across international borders. International expansion done right can lead to sustainable growth and ensure the long-term success of a company. The wrong move, however, into the wrong market at the wrong time can derail company growth and even lead to a company's demise. How does your company identify the right opportunities in international expansion and make educated strategic decisions by understanding the legal and political as well as economic implications of expanding across international borders? Well, today, renowned international business experts, Dr. Sean Nair and Amy Sperling, who have led successful international expansions of their companies, will offer best practices in international expansion in both theory and practice. Today's content will include the steps companies should take to ensure that they are truly prepared to expand, know what they need to keep in mind when hiring employees in foreign countries, and little-known tax, compliance, and legal issues that can sidetrack expanding companies. Before we get started, a quick note about Proformative for those of you for whom today is your first Proformative webinar. Proformative is the largest and fastest growing online resource for senior finance and related professionals. We reach over 500,000 of those folks on a monthly basis, and all we do is answer one another's questions all day long. So it's a peer-to-peer network, and it's CFOs talking to CFOs, controllers to controllers, etc. It's all free and completely ad-free and no self-promotion. So it's a wonderful place to share knowledge, and feel free to check it out at proformative.com. Now, a couple notes on today's event. A link to today's presentation and the video of this webinar will be sent out to all attendees within 24 hours of the event. And the presentation, as well as the video to this webinar, will be posted on the proformative.com site for free use and download. So if you want to check this out later or pass it along to others, please feel free to do so. And that, of course, is free, like everything on Proformative. Secondly, those who would like CPE credits will need to answer all of today's polling questions. There will actually be two, one in the middle, one towards the end. And you should have pre-registered for CPE credit. If you have any questions at all, please contact Tanya Walsh, and you can see her email right there. And if you didn't pre-register, don't worry, we'll just catch you on the back end. But please make sure to contact Tanya. Third, please ask questions. We want this to be an interactive experience, and there is a question box in your GoToWebinar control panel. If you'll take just half a moment to glance at it right now, feel free to ask questions at any time during today's presentation, even if they're clarifying questions, what should I do, or my audio isn't working, etc. Please just ask away, and we'll do our best to answer them as we go. Questions for today's speakers we will hold until the end when we get to the Q&A section of today's event. And finally, after you leave today's event, immediately upon getting out of the webinar, you will be prompted to take a short survey. We would greatly appreciate your taking just 1 minute to answer a couple of quick questions. It's mostly just clicking. And if you would like us to connect you with either of today's speakers, you can make that request in that survey, and it's literally just a click. So we can get you connected very quickly and very easily, and we're extremely happy to do so. Please keep these 4 things in mind, and we're very happy to have you here. We're going to be covering a lot of content today, and I'll just, I'm not going to go through each of these bullets, but we'll say that if you or your company have any interest in international expansion, you're going to have a lot of interesting insights to take away from today's presentations. And that's enough of me talking. I'd like to go ahead and introduce our first speaker. Today, Dr. Sean Nair, who is the co-founder of Nair Co, will be leading us off. He is an expert in international expansion, a highly sought-after speaker on globalization, and a contributing author for various publications. Since founding Nair Co in 1994, he has helped grow the company from a small UK-based professional services firm into a global enterprise with offices in the UK, India, China, the US, Japan, and Singapore. Sean oversees the company's business strategy with an emphasis on client care, new business development, and the proactive use of technology to secure business advantage for clients. And with that, Sean, welcome, and please take it away.
Thank you very much indeed. Good morning, good afternoon, or good evening, ladies and gentlemen, depending on where in the world you are at this point. Before I came into this room to do this webinar, I spent a few minutes creating some content that's not in any of my slides, but is pretty topical. Bearing in mind that further recessions may be on their way given the current uncertain economic climate even before we recover from the previous one, I was thinking, what are the risks that you should be worried about if you are an exporter, regardless of whether you have offices abroad or not? The first one, and I've created a few bullets, and I'm going to run through them very quickly before I jump into my slides. The first one is the risk of non-payment, either due to currency controls being imposed or of your customer going into liquidation. And this is particularly topical if you have customers in Southern Europe, particularly not just in Greece, but in the Southern European Eurozone countries, where they may remain within the Eurozone, but the economic climate could be so bad that the customer could go into liquidation. In those circumstances, making it part of the contract to get your customer to forward purchase in the right currency and screening your customer particularly carefully for their credit risk would be a good thing to do. Secondly, in the rather unusual situations that we are in today, you should be considering political risks and the need to take credit insurance even more carefully than before. Often you may well assume that if you've got an irrevocable letter of credit, you don't need credit insurance. But if some major political event happens in a country, that means that you are only able to ship the goods to your customer after the expiry of the irrevocable letter of credit, then the contract could be frustrated and you could have unrecoverable debts if you're not insured. So it's important to just take that factor into account on the off chance. There are also risks to the financing of your operations. Just 2 days ago, the Netherlands government, as an example, presented to Parliament proposals to restrict deductibility of what they call the participation interest expense. So in other words, if a US company buys a Dutch company and puts debt into that Dutch company as part of the acquisition, these proposals would restrict the tax allowability of the interest arising from that debt in the tax computation of the tax liability of the Dutch company. Basically, we have, this is all being driven by the need for governments everywhere to raise revenue, and that is a factor that you need to be taking into account when you are engaging in international trade. Another factor one needs to worry about is increased inflation. So, for example, if in Europe certain countries fall out of the Eurozone and go back to their national currencies as a way out of their economic problems, there is likelihood of increasing inflation. And therefore, it is important that the prices that you negotiate are fixed in a stable currency, of which, of course, the US dollar is the best one. You should be prepared also for increased attacks by regulators, but not just in the conventional manner. For example, in Singapore recently, a company was fined $25 million for failing to follow proper import procedures. So where you are using, say, a goods fulfillment company, it is very important to demonstrate that the third-party forwarder that you're using has got records that are sufficient to demonstrate compliance with the import and export procedures. As if that is not the case, then ultimately the liability becomes yours. Last but not least, if you are a larger company with significant supply chains, it's worth looking at ways in which you can reduce the length of a supply chain and therefore reduce your costs. Because often these supply chains kind of grow from A to B to C to D, and they can be quite complicated when actually you could cut many loops out of it and save money when it comes to delivering goods. So I just put a few bullet points there. This is literally hot off the press and put together a list just an hour or so ago. which I thought might be of interest to you and which could perhaps form the basis of questions and answers, maybe if you're sufficiently interested. Now, moving on to the next presentation, the next slide, and I'm just, I think what I did worked, The next slide, which is shown up now, gives you a summary of the topics that I'm going to cover. And really, they are issues that arise in chronological order when you are hiring personnel for the first time in a new country. So I'm going to go through typically the need to establish what the going rates of remuneration and benefits are, the need to ensure that the very first employment-related document that goes out is local country compliant, and how you can use the rights that you would have if you reserve them as an employer, how you should take advantage of those. Then I will look into the tax structure, because obviously the tax structure drives who the local country employer is actually going to be. Then I'm going to look at the necessary HR and tax-related infrastructure to support that tax structure. Then I'm going to look at compliance, which usually happens as you go along throughout the year, having now been set up. I'm also going to touch base very briefly on the exposures that you personally would run if any of you agree to be a director of a foreign company. And I'm going to touch on it by showing you some examples. And last but not least, I'm going to look at a scenario where you're already established multi-country and expanding and having a hard time managing your G&A. So without further ado, let's go to the going rate slide. First and foremost, salary surveys for privately owned companies where employees may be offered equity-related compensation. The kind of available general salary surveys are not all that relevant because they're dominated by the statistics of the multinationals. It's therefore important that you get, even before you start the interviews and look at the resumes, that you have a good idea of what the going rates of remuneration and benefits are for your particular business sector and type of employer. This is best done typically by talking to recruitment consultants and HR consultants who have expertise in these areas, helping companies with your type of profile, rather than looking at global salary surveys where the Ciscos and the Intels of this world tend to dominate through the sheer dint of the numbers of the employees coming into the survey, which biases the results of the survey. It's also important, once you've established the typical salary band, that you also establish what the benefits are. In certain countries, these benefits, there is no mandatory requirement to provide benefits, but there are market rates, and you need to know what they are, so that when you enter into the negotiations with a prospective employee, they stay at a realistic level and don't go to a level where you pay more than you need to. You also need to take into account in certain countries, particularly in Southern Europe as an example, France, Spain, Italy, and Portugal, the unions have collective bargaining agreements with employers which set a floor on benefits over and above the mandated legal minimum. And not just that, that this floor is also dependent on the classified grade of the employee. For example, in France, there are 3 levels of seniority, 1, 2, and 3. And typically, overtime rules do not apply to the highest level, but the termination costs of a highest level are very high. Level 2, a restricted type of overtime treatment is available and must be done. But the compensation in the event of termination is not as high as level 1, and level 3 is the blue collar, where you have to keep time records. So you need to be aware of all of these types of rules before you actually go into a hiring position in that particular country. If you are planning equity compensation, it's important again that you factor that into your overall assessment, and in particular that you look at what the costs are of maintaining an equity compensation regime in that particular country. For example, many companies with employees in India and China, many but not all, do not provide stock options. They actually provide phantom options, In the case of China, it's because the cost of registering a U.S. stock option plan with the Chinese regulators, there are multiple ministries involved, and then the ongoing cost of administering the stock option plan can be quite onerous. In the case of India, although the registration side is not onerous, the Indian authorities require annual revaluations to be made, which can be quite expensive. So many companies opt instead for phantom plans as opposed to real plans. So it's important when you look at the various countries that you look at what tax breaks are available to you, what the market norm is, what the cost to you of providing this type of compensation is, what the market norm is, and then taking a decision on what is best for your company after you are fully informed of the background. There are also certain countries where, in fact in all countries, there are certain compulsory employer insurances which vary. But the temptation to go to your global broker and ask him to give you insurance coverage in that particular country should be tempered by your taking local country advice. A good example of that is France. Let's say you're setting up a French company and you want D&O cover for your U.S. directors who are going to be the directors of the French company. There are some French regulations that require that the D&O coverage is obtained from an insurer with an underwriting office in France. So your U.S. broker may not automatically be aware of these regulations, and therefore it is important that you are, however, and that you therefore get the right kind of policy in place for those for your personnel, because otherwise you may find that although you think they're covered, a claim arises and the policy is thrown out by the judge because it doesn't comply with French regulations, and now you're on the hook for the compensation. That covers very quickly the going rates of remuneration. So now we move to the terms of employment. So now you know who you're going to hire, you know what the going rates are, you reach the deal with the relevant individual, and now you need to generate the paperwork associated with it. The temptation of many companies when they are entering a new market is to tow the water with contractors, or alternatively to use temping agencies as a kind of PEO to hire these people through. This type of approach is okay in certain countries as a permanent arrangement, and it's okay in other countries as a temporary arrangement, but there are risks involved. So typically, for example, if you're going to do this in Hong Kong, for a period of up to about a year, you're probably okay. You're running some risks that the person would be a deemed employee, but in Hong Kong you pay employees gross, and the cost of the employment to the employer is actually the payment into a provident fund, which is mandatory if the person is an employee. So your biggest risk is that this person is deemed to be an employee sometime down the line, and you're asked to make backdated payments, to set up the provident fund and make backdated payments into it, which is not a huge kind of risk. On the other hand, if you're hiring contractors in Europe for periods exceeding 6 months, it is risky. It's risky from 3 aspects. First, the contractor will acquire deemed employment rights, and when you then terminate the contractor per the contractor agreement, you may well find yourself in court, in an employment court, being sued for improper termination and for damages arising therefrom, which you weren't even aware of. Secondly, because they're deemed employees, you could be running local taxation risk, because if you've got employees of a foreign company directly operating in a country, you're doing business in that country, you're not doing business with that country. Thirdly, and even worse, and I've come across a few horror stories on this one, which are companies where they've been burned, is where if you have a sales employee who's a contractor, and that sales employee is extremely successful, and now you decide to insource it and say he doesn't want to be an employee, he can sue you for loss of goodwill of the business that he's generated for you, which in one case I came across 4 months ago, ended up with the company paying $1.5 million of compensation. So it's penny wise and pound foolish in my view to use contractors as a permanent arrangement in many of the countries in Europe. A much better option is to set them up as temporary employees. You have to be very cognizant of the rules. France is one of the countries where it's hardest to have temporary employees, but if you have a good business case and you make sure that you remind the employee before the end of the temporary contract that their contract is about to expire, then you will be able to avoid risks of having that person on your books as an ongoing permanent employee. Regardless of whether you're hiring temporary or permanent employees, if you're going to send them, you will have to send them a local country compliant employment agreement, or even better, issue them with a staff manual or an employee handbook, as we call it over here in the US. But whichever you do, it's very important that you reserve rights that you would lose if you don't reserve them. So I'm thinking here of rights like the payment in lieu of notice clause, the length of time you wish to keep them on probation, and by the way, the maximum length of time does vary from country to country within Europe. The right to put them on garden leave, which often, when combined with a long notice period, can be used to avoid having a non-compete, which could be struck down because in the event that it seemed to be a breach of European human rights rules. So rather than a non-compete, which could be risky, you could combine a garden leave provision with a long notice period to get around it in a legal manner. But you need to reserve all these rights up front if you want it. So just taking a template employment agreement and whacking it out is not, in my view, the best way of controlling your long-term costs, albeit a good way of keeping your short-term costs right down. There are also special cases, and I've listed here 4 that immediately came to mind when I was doing this slide over the weekend, and those are Italy, Spain, Portugal, and Brazil, where they have 13th month and 14th month salaries. And again, these must be included within the wording of the employment agreement. Otherwise, you could find yourself on the hook for an additional month's salary twice a year in the case of Brazil. So I'm just touching here on a few things that you should be aware of when it comes to setting up the terms and conditions of employment. It's very important to think about it properly, take account of all of the facts, decide what your business needs, and then draft them accordingly. Now we come to who is the employer. Basically, in most countries, there are 3 levels of infrastructure. There is the ability of the foreign company in certain countries to directly register for payroll or to set up a representation office. I'll call it an RO for short. Then there is a branch, which again is a local registration of a foreign company, and then there is a subsidiary. The main advantage of the rep office approach is that it is a rep office is a non-taxable registration of a foreign company in that country. It means that you can legally payroll the employees, you can withhold taxes and Social Security and pay them over directly yourself. But the downside is that although it's got no requirement to keep accounts or to pay corporate taxes, there are restrictions on the type of activities that can be conducted within them. So, for example, typically you would not be able to hire more than about 2 or 3 people in a rep office. You will not be able to hire a senior person like a regional director or a VP of Europe in a rep office, because by definition it is assumed that a senior person is conducting core functions of your business. But within those constraints, you cannot hire salespeople and pay them commissions, but you can pay performance-related bonuses to market research people. So within those constraints, if you can structure it that way, you would be balancing your risk and your cost in an acceptable or a generally acceptable manner. The risk you would be having is that at some point you could be deemed to have had a branch, and the branch is a taxable entity. So you would be running a risk of having to pay back taxes, back corporate taxes assessed on a cost-plus basis, and pay some interest and penalties based on a cost-plus on 2 or 3 people for a few years. But if that's an acceptable risk, then your cost of setup would be minimized at the early stage. It's also very important, actually, when you're setting up a rep office, that you think ahead as to how your business might develop over the next 3 to 5 years. So, for example, if you're setting up a rep office in Germany, and you think your business will grow to a 10-man German subsidiary in 5 years, you should be careful not to declare in the paperwork and to indeed carry out local country R&D type assessments of, say, typically what type of customization your product might require in that country, because those kind of activities could be used as an argument to say that when years later you have your GmbH, because you did some of your local IP development in Germany, the GmbH is entitled to some of the IP revenues that you're booking in the US. So you do need to think ahead a little bit when you go down this low-cost rep office approach as to what the risks actually are, what you can do to, in terms of presentation of your case. And obviously the presentation has to tie in with what you're doing on the ground. Often when you're setting up a branch is really a rep office in which you're carrying out core activities. So there's no limit on headcount, there's no limit on type of activities, but the branch is now a taxable entity, usually on a cost-plus basis. The danger of continuing with a branch long-term is that the company of which the local operation is a branch could acquire a local taxation presence. And for that reason, it's often useful to put a blocker company in between. The blocker company would be a shell holding company, so that even if it acquires a local tax presence, if it's got only a small amount of profit in it, you're not all that bothered. Having said that, there are some notable exception cases. For example, rep offices can be taxable in certain countries, such as Spain and China. But in China, you cannot put a blocker company in between if it's less than 2 years old. It needs to be two years old and to have a trading history before you can actually use it as a blocker. In the case of Brazil, for example, a branch requires presidential approval, and Brazil does not have the concept of a rep office. So you have a problem if you're going to hire 1 or 2 people in Brazil, because you don't really want to set up a limitada, but it's the only real surefire, 100% bulletproof, expensive option. The last option, obviously, is the subsidiary. It's great because all your risks in the country are ring-fenced, but you do have transfer pricing and revenue recognition issues. And the biggest downside is obviously that if you pull out of the country, there is a high cost in terms of shutting it down. So that completes the who is the employer part of this. So now let's look at the necessary infrastructure. Would be really listed here for a subsidiary. Obviously, you need an intercompany agreement. A lot of intercompany agreements are drafted by corporate tax people, and it's rather important that the intercompany agreement is also reviewed by an indirect tax specialist, because your biggest risk with an intercompany agreement is that it's worded in such a way that a few years down the line, the VAT authorities would ask for it and could, through wording that's inadvertently in there, deem that you could have provided or do provide VATable supplies. Because if you are providing VATable supplies to your foreign customer through that intercompany agreement, there is a risk that VAT could be slapped on the intercompany invoice. And that would be a big cost. If, say, 20% VAT is slapped on 3 years' worth of intercompany invoices on a 10-man cost-plus French company, is quite a sizable VAT bill, which the US company won't easily be able to recover. So it's important that intercompany agreements are actually reviewed by VAT people before they're finalized. And that sometimes does not happen when they're drafted, by the big accountants and lawyers, because they're kind of structured in departmental-wise, and intercompany agreements tend to be done by the corporate tax department. A number of companies in the current price-sensitive, cost-sensitive environment are giving into the temptation of using templates. Just run off the template. What was my intercompany agreement that I used in my last job? Run off the template and just sign it off. In my view, that is very risky and not one that I would ever recommend, because the intercompany agreement needs to be drafted to fit the precise circumstances of a client. And even two competitor companies doing similar things in a country, the detailed activities are not the same. And these agreements need to be customized to exactly what the employees are doing. Otherwise, there is always a risk. Thirdly, benchmarking the cost-plus percentage or the transfer price in the intercompany agreement is very important to do. to a varying extent. In Europe, I would say you should benchmark it at the beginning and then benchmark it maybe once every 4 or 5 years. In India, because of the huge attacks companies are receiving, you should benchmark it every year. And in China, you should benchmark it every 2 to 3 years. So benchmarking is important to do, however. It used to be something that people didn't do much up to 5 years ago, particularly for smaller non-material operations. But even in those circumstances these days, given the exposure from the tax authorities doing audits, it's required. I mean, in the case of India, for example, every foreign subsidiary, Indian subsidiary of a foreign company, has to make a special filing with a special office of the revenue authorities that deals with transfer pricing. And the benchmarking report, if it's not there, could get picked on, and the risk of an audit greatly increased. And in India, there are audits happening. We have a client at the moment where the tax authorities are demanding cost plus 40%, which is absolutely huge. So you're having a justification as to why it shouldn't be cost plus 40%, it should be cost plus 15% is very, very important. Okay, so now we move to compliance. With compliance, this is pretty straightforward. You have payroll or other compensation-related compliance, accounts and tax-related compliance, equity compensation-related compliance, and corporate governance-related compliance. And really, I've kind of listed them up. Some of these compliance actions happen throughout the year. Others happen at the year end. A good example is VAT. In Germany, you do monthly VAT filings, but you also have to do an annual filing to another office of the customs authorities at the end of the year. The local GAAP account reporting detail can vary. The easiest country from this point of view is Netherlands, where you simply file a set of accounts with the Chamber of Commerce, and so long as your chart of accounts is quote-unquote reasonable, it's accepted. In the UK and in Hong Kong and Singapore, there are very specific basis on which you prepare the local GAAP accounts, and you have to prepare a report that is wrapped around those accounts, again, in a preset manner that has to be filed, so the amount of work involved is significantly more. But these are all local requirements that basically you need to be aware of, you need to know the timelines, and if you're a public company, sometimes your requirements may be to file before the deadline, like a month or two before. In other countries, there are certain countries have stock option and ESPP related filing requirements and others do not. All countries have payroll filing requirements. Some countries have a different method of assessing corporate tax. So in other words, the tax is not calculated from the local GAAP accounts, but from a set of tax accounts that have to be calculated on a slightly different basis to the local GAAP accounts. UK is an example of that. And in certain other countries, there are filings, there may be statistical survey or other filings. A good example is Australia. ASIC is the equivalent of the Australia Companies House. A small company in Australia can get an ASIC exemption so that it has to file a set of local GAAP accounts, but the filing is less complex than the full-fledged filing. But in return for that exemption, they have to make a separate filing to ASIC every year to be able to maintain their small company status exemption. So this is really kind of standard process stuff, but it does require a high level of organization and discipline in order to make sure that they're done on time. Next page is director exposures. I'm just going to touch on this because many clients, tend to sort of just say, okay, I'll be a director of the French company or the Chinese company, and they don't really know what they're taking on. In the case of China, I'm afraid the rules are loaded one way. So if a Chinese subsidiary of a foreign company infringes the IP of a Chinese company, the worst case is a death penalty for the director. If, on the other hand, a Chinese company infringes the IP of a local company, your recourse is through the courts. I've not known of a case where the Chinese company's director had a death penalty, put it that way. In the case of Australia, Australian regulations impose pretty onerous criminal penalties that can lead to jail sentences for directors who irresponsibly run their companies, do not maintain a set of accurate books and records, don't make filings on time, and don't pay the right amount of taxes. And where that's judged to be willful, criminal sentences can apply. Canada, on the other hand, has a big focus on environmental concerns, and it's really environmental offenses by a company that can result in imprisonment. In the case of Japan, the Japanese Civil Code requires the directors, including the local resident director, which is known as a representative director, with the responsibility for keeping a good quality set of books and records, and to have proper backup, not just do the filings on time and pay the taxes on time, but to have proper backup to support and validate these filings. And the person is personally responsible, and failure to do that can lead to imprisonment. In the UK, the main risks to a UK company director arise from breaches of data privacy or breach of the UK's Bribery Act. So for example, the UK Bribery Act is very wide-ranging, and if you have even one employee in the UK, it applies to all of your operations worldwide. So you have to be cognizant of that often these bribing situations happen without the knowledge of the local director, leave alone the knowledge of a director of one of the UK companies. But that person can actually be incurring a personal risk as a result, which could be have negative consequences for him. So I'm just touching on this, but it is just a point that should be borne in mind. Next slide is looking now at this company having a hard time. It's got 15, 16 people, say, in 4 countries, and it's doing one of several things. It's got local accountants, payroll companies, bookkeepers, HR consultants, different ones per country, and maybe they're in 2 or 3 time zones. And there's somebody in the US tearing his or her hair out, managing all this, and getting information together for monthly board reporting packages. The risk is a lack of consistency, and it's not a scalable model if the company is going to expand further. Some companies use an accounting consolidator. So the accounting consolidator would have a in-region person who would be pulling together all these diverse service providers, putting information together and acting as a kind of post box through which communications flow in and out. And again, that has got advantages up to a certain point, but it's not a scalable solution. On top of that, if the company is public, or the company is perhaps intending that it be acquired by a public company, then especially in the material countries, SSA 16 compliant procedures are very important. And again, try asking an accountant in Taiwan what SSA 16 means, and you'll see where the problem is. Some companies get around that by centralizing all the accounting in the US, and then just using local firms for the local country compliance. That has got certain advantages, but typically the biggest risk run is that if the person keeping the accounts of these foreign companies in the US doesn't understand how VAT works, then the VAT returns could end up being incorrect. Or alternatively, there could be an inconsistency between the US accounts and the VAT returns, because the VAT returns are showing certain numbers reclaimed, but the person keeping the books in the US doesn't know which amount of VAT can be reclaimed and which cannot. And so some VAT that's reclaimable is shown in the P&L as opposed to being shown in the balance sheet. The accounts could be wrong. So really the kind of fallback position for most of these companies is to use a shared service center. Now, if there's enough transactional volume, which typically the Googles and Microsofts and so on have, then these companies would have internal shared service centers. And these internal shared service centers would typically be covering a region and would be located somewhere fairly cheap. For example, one company I know of has a shared service center in Azerbaijan that services all of continental Europe, including all the core Western European countries. Alternatively, if if the company is kind of too big to be small and too small to be big, in other words, it needs a shared service center, but it doesn't have enough transactional volume to actually have its own internal shared service center, then it would obviously need to outsource it to a firm providing that. And in the next slide, I've just listed typically schematically how a shared service center typically works. And this is my last slide. Typically on the right, there will be an accounting team headed by a manager that runs all the payrolls and keeps the US GAAP accounts. So because these accounts are kept centrally, they're kept in a consistent manner with each other. And it means that the US can get questions answered by people who have their fingers on the numbers as opposed to somebody in the middle. It also means that basically when compliance time comes along, accounting information can be efficiently transferred within that shared service center from the accounting team to a compliance team. And typically there'd be another multi-country contact. They've got different names, but typically that person would deal with all of the compliance and consulting requirements that the company has as it expands or contracts. And typically the consulting requirements are often in HR, legal, and tax. So that is a kind of schematic. And at this point, I think I'd like to stop. Thank you very much indeed for your time and for listening to me. And I hope I haven't bored you too much.
Not at all. That speaking as a CFO who's had many, many foreign subsidiaries, this was very familiar and extremely useful. I thought that was great information. Thank you so much there, Sean. At this point, we're going to quickly launch into a polling question. This is the first of the two CPE polling questions on today's event, and I would appreciate it if folks took this kind of quickly so we can keep moving on and have plenty of time for our next speaker. Amy, I am going to ask you to keep an eye on the clock, and if you could be done by 5 minutes till, that would be great. And by the way, even if you're not here for CPE, it would be interesting, statistically speaking, to see what you have to say about where your company has interest. By the way, this is all, your name would not be associated with your answer in these polls, so don't worry about that, but statistically speaking, it would be interesting. And I'd like to remind folks, even though we're probably not going to have a ton of time for questions, please feel free to ask your questions, and if we don't have time to get to them today, I will work with today's speakers to get them answered for you, even if we have to do it offline later. So with that, I'm going to go ahead and close this poll question. And it is my pleasure to introduce our next speaker today, and she is Amy Sperling, the Chief Financial Officer at Athletes Performance, Inc. Amy has spent her career working in high-growth and startup companies, all of which have been involved in international expansion. As CFO of Athletes Performance, Amy is responsible for all aspects of accounting, finance, and HR, including raising capital, international expansion, and investor relations. In her tenure at AP, Amy has directed the company's international operations in 8 countries, with another 3 on deck. Amy came to Athletes Performance from Maven Networks, where as controller, she was responsible for managing the M&A diligence process, as well as the consolidation with Yahoo, including all international operations. And prior to Maven, Amy was a director of finance at a boutique investment bank in Boston that specialized in incubating technology startups. And with that, Amy, you have control. Take it away.
Excellent. Thank you, John. Thanks, Sean. That was great as well. I wanted to first start by just explaining a little bit about what Athlete Performance does, so that when I'm discussing how we've approached expansion, it'll make a little more sense. Athlete Performance is a health and wellness company that provides training to professional athletes and teams, as well as to corporate clients who are interested in wellness programs for their populations. So we have 2 very different sides of our house. We are an IP-based company that essentially uses our professional athlete training division as a funded R&D lab to develop software, hardware, and services that allow us to service normal people, so corporate clients who don't need to know their time for a 40. So our expansion has come from both the athlete side, which I'll call the elite division, and the corporate wellness sides of our house. On the elite division side, we've come under a push strategy. So what typically happens is sales spend several years working with typically governments in other countries discussing team arrangements. Notably right now we are training 14 teams in China for the Olympics. We should have about 50% of their medal count is falling under our training. That relationship came about from years of working with the Chinese, and it takes a long time to develop those relationships because they are very senior level within different companies. So we are actively seeking out those relationships and developing them. On the corporate wellness side of the house, we are being pulled into countries by our clients. So our U.S.-based clients are typically Fortune 500 companies who want to include our services as part of their corporate wellness offering to their employees. As we have gained traction in the U.S. with these companies, they look to expand our services, typically gym-like facilities, into their locations in other countries. So we end up being pulled into countries, particularly in Europe right now, with these clients. To date, we are in Germany and France with our U.S.-based clients, but we also have Ireland, Switzerland, and the U.K. on deck for the next 6 months. So depending on whether or not there's a pull or push strategy that is the driver, we have both contract and corporate structures that are affected. The interim strategy affects the scope of the initial contract with regards to the amount of services we can provide, as well as the speed to entry in the countries and the necessity to find temporary workarounds when we cannot be completely set up at go. It's often a typical scenario where I have less than 6 weeks notice from a contract being finalized or close enough to finalize to when I need to have actual people on the ground. All right. Corporate structure is driven by these different factors. So as Sean mentioned, there are different options for footprint size in each country. So there's registered offices, there's branches, there's subsidiaries, and which you use as you go into these countries is determined by what your needs are and how big you want your footprint to be. Items that we consider when we're looking at these countries are how many employees are going to be required to be on the ground to service this contract, both ideally in an optimal situation where sales could have as many people as they'd like, and also minimally what was the fewest number possible to service this client without going over certain limits. As Sean mentioned, with registered offices in various countries, there can be an employee limit where you trip over into needing a larger footprint. I also look at how long a contract is likely to be. If I'm looking at a small entry-level contract that is going to be for a year or less, I want to make sure that I'm managing the setup within that country to not create such a large footprint that we can't get out or it's difficult and costly to get out if that contract goes away. It's the decision to move into a country based on one contract or on targeted sales push. So again, if I only have one contract within a country, I'm going to look to minimize the footprint in that country versus if we're doing a targeted sales push within a larger country like China right now. We set up far more permanent structures because we know that down the road we are going to have additional contracts that we are planning to have within that country. These levers and triggers can add and reduce complexity when you expand internationally. Doing your homework and answering these types of questions up front allows you to protect your margins. There are varying costs associated with the different setup options, both on a one-time and on an annual basis. Some countries require compulsory audits that are annual and are costly. Others, you can get away with the minimum filings around a payroll registry or a registered office. In my role, I'm continuously weighing the pros and cons of the various options as we look out several years to make sure that we're preparing ourselves for the future, but also managing the risks and the costs right now. I want to make sure that we have the fastest, cheapest, easiest way into and out of any given country, but that we are also set up so that we are in compliance with local laws within those countries. That has led us to have a fairly complex international expansion or corporate structure. So at the top, we are one C Corp. Underneath that, we have 13 different subsidiaries. Several of these deal specifically with one side of our one division or another, and then I have entire entities that are completely housing international contracts that are, the 6 to 8 week engagements internationally, so my accountants can manage those tax filings, as well as branches that are set up specifically for one country alone, like China. We've learned a lot of lessons along the way as we have moved into these countries. One of the key takeaways for me as I have worked through this, and now the third company I've taken internationally, is to stay very close to my salespeople. They are the closest link to give me visibility into when we are going to be entering a country. So understanding exactly where various contract talks are in process, understanding the timing that from the client's perspective as to when they would like services to begin. All of that is very important in giving me an additional week or 2 weeks of time to set up and prepare for when we need to enter the country. Before I have a contract signed, I start the process to know my options for going into a specific country. If I waited until contract was signed, often there is not enough time to get somebody legally on the ground. So that process needs to start in advance as minimally as possible, because if the contract does go away, you don't want to have committed a lot of funds to that process, but you need to do your homework in advance. Data privacy and PCI compliance has been a big issue for us as we move internationally. There's been a huge increase in regulations within the U.S. in recent years, and there is also, this push has happened internationally as well, particularly in Europe. One thing that we have found is that what is considered personal data in Europe is very different from what is considered personal in the U.S. In Germany, for instance, height and weight are considered essentially the same as medical data. So transmitting, storing, protecting that information is the same as blood type or medical results. So where we didn't have those regulations in the U.S. and we aren't considered to have medical information, that is very different internationally. There's been increased scrutiny by the international authorities on this as well. Our clients moved internationally and brought us with them into France and Germany. We went about setting up the correct paperwork so that we could have the correct waivers and forms available for the client's employees to sign up. However, we discovered that because of the French review of our client company and their documents, we were subject to increased scrutiny. So we had to spend a lot of extra time going through a very long diligence process with the French authorities to establish the fact that we are an independent company from our client, and that added months to the process that we were not anticipating and was not something that was originally planned for. So any extra lead time that you can get from either the sales process or from working directly with your clients is key to give you the needed time to move into a country. Sean touched a lot on the new hire expectations, the salary banding. I can't stress this enough. We have found that as we have moved into different countries, this has been key to how we staff our facilities. In France, we have found, for instance, no one works over 35 hours a week. The concept of part-time and full-time and overtime just don't exist. So throwing more money at it and assuming that somebody would be willing to work 40 hours a week was a false assumption on our part, and we have had to restructure our contract with our client to account for that. Health insurance requirements per country, those vary as well, and what employees expect. In some countries, supplemental insurance to go with the socialized medicine is encouraged so that employees can essentially jump queue in the medical line. In other countries, it is not a necessity, and so there's no need to purchase that extra insurance. The salary ranges for positions from country to country for various positions also varies. So knowing those ranges and that salary band is very important. And then knowing that there's key contract structures that have helped us as we've moved internationally. key pieces with regards to contract hedging have been important. Whenever possible, I structure our contracts so that they are with our U.S.-based company and allow us to have the contract written in U.S. dollars. Whenever that isn't possible, I have worked with one of our banks to set up hedging on these contracts so that the contract can be written in local currency, but at the same time, I can guarantee that I am receiving the amount of money I'm anticipating and I can recognize the correct amount of revenue. Without that, we would be subject to currency fluctuations on the market, which means large adjustments, particularly at the end of a contract. The other key term that has been really critical to us has been assignability. So being able to assign one of our contracts from one of our entities to another has allowed us to move quickly into a country in one of our kind of international holding companies, but allows us to assign it to the correct German-based or French-based company after the fact, so that we do have the contract in the correct location and it can be handled correctly. But this allows us to at least get started with the company and do a workaround until we are completely set up. And then, so expanding internationally has been exciting and challenging for us. The key thing that has helped us is we have a very small team is to work with international consultants that can help you kind of navigate these waters. As you can see, we've entered 6 countries in the last 6 months. There's no way I could have anyone on staff who would understand all of that complexity. So finding key partners and contractors and consultants can help navigate that. Thank you.
Thank you very much. That was excellent, Amy. And since we're getting to the end of our hour, I'm going to go ahead and launch our final polling question. Once again, whether or not you are here for CPE credit, would love you to just take a quick moment, very easy question to answer, and would love to see the results. I'm going to go ahead and go into the final information on this webinar, since we're running up near the end of our time, and we'll let folks just take that poll while we roll here. First off, obviously, thanks so much to Sean and Amy for your time and insight. Just wonderful content today. Great education from Sean that really covered a very broad swath of issues. And then, Amy, it's great to have the first-hand perspective. So thanks to both of you for your time today. Second, if you have any questions about CPE credits, please contact Tanya Walsh. I'm going to go ahead and close down the polling question and pop her contact information back up on the screen. She manages our CPE credit program, and she will be happy to answer any questions you have. Her email is at the bottom. And also, you will be presented with a follow-up survey after we close down this webinar. Please give us just one more minute of your time, and we greatly appreciate hearing what you thought about today's event and what we could do better. Plus, if you would like to connect with either of today's speakers, please indicate that in the survey. It's just a mouse click away. It's that simple. And finally, we greatly appreciate the support of our sponsor today, Nair Co. Without their support, we wouldn't have been able to bring this to you, not only at no cost, but just the wonderful, deep, educated knowledge that we were able to bring today. And for that, we really appreciate their support. So Nair Co. Thank you so much, and we're at the stroke of 12 o'clock Pacific Coast and 3 o'clock East Coast. So thanks, everyone, for your time today. We hope to see you again at another performative event or online at www.proformative.com. And with that, I will go ahead and end today's program. Thank you so much, everyone.